Hello everyone, my name is Prateek Mishra. I did my mechanical engineering in the year 2010. Currently I am pursuing a program in information security management from MIL Academy, Mumbai. My topic for today's presentation is Sarbanes-Oxley Act and its effect on information security. Shall I move on? My agenda for today's presentation is I'll give an overview of Sarbanes-Oxley Act. Since Enron scandal was the main thing behind the enactment of this act, so we will talk a little bit about the Enron scandal. We'll see the basic terminologies of Sarbanes-Oxley Act as well as the various titles and sections of the act, implementation of key provisions of SOX, analyzing the cost-benefit analysis of SOX. We will study about the benefits and disadvantages of SOX, and ultimately we'll conclude. The main intent of Sarbanes-Oxley Act is to protect investors by improving the accuracy and reliability of corporate disclosures made pursuant to the security laws and for other purposes. Sarbanes-Oxley Act, also called SOX, was enacted on July 30, 2002, is a United States federal law which sets new or enhanced standards for US public accounting firms, public company boards and management. The Act is named after US Senator Paul Sarbanes and US Representative Michael G. Oxley. The act was legalized as a reaction to a number of major corporate and accounting scandals which shook companies like Enron, WorldCom, Tyco International, Peregrine Systems and Adelphia. These scandals, which cost investors billions of dollars when the share prices of the affected companies collapsed, shook the public confidence in the US securities markets. The Act does not apply to privately held companies. The Act contains 11 titles or sections ranging from additional corporate board responsibility to criminal penalties, and requires the Securities and Exchange Commission to impose new requirements to comply with the new law. Debates continues over the perceived benefits and costs of Sarbanes-Oxley Act. Supporters of the Act says that the law was necessary and it helped in restoring public confidence in the US capital market by strengthening the corporate accounting controls, while the opponents of the bill claims that it has reduced America's international competitive edge against foreign financial service providers by bringing in strict regulations on the US securities markets. Before going into the core of Sarbanes-Oxley Act, before studying about the various titles and sections of acts, we must go through the terminologies which is generally used in Sarbanes-Oxley Act. The various terminologies are public listed companies, public accounting firms and Securities and Exchange Commission. So now we will see what are these. Public listed companies are those companies which are listed under the Securities Exchange Act of 1934 in the United States of America. All companies which want to go public, they first issue an initial public offering, which is the first sale of stock to a company. And the main intent of going to public is to raise capitals which could be used to fund capital expenditures, which could be used to fund research and development projects, and it can also be used to pay off existing debt, if any, on the organization. The first company to issue shares is held to be Dutch East India Company in the year 1601. There are many advantages and disadvantages for a company going public. The various advantages, as I mentioned before, is first, the basic advantage is it gains financial benefit, it raises capitals which can be used for various purposes, because it increases public awareness about the company through IPO, the market share of the company increases. There are various disadvantages as well. As per United States Securities Exchange Act of 1934, all the public listed companies have to undergo the strict regulations of Securities Exchange Act. They have to undergo enhanced financial disclosures periodically. They have to fill in Form 10K reports on a periodic basis, wherein they have to fill in the off-balance sheet transactions, pro forma figures, and everything related to credit and debit. And the cost of compliance for smaller companies who want to go public is high, because they have to indulge many certified public accountants to do their financial reporting. Also, there is much paperwork which needs to be done, which is bureaucratic paperwork, and that's why the cost of compliance increases when for smaller companies. Also, the published accounts must be prepared on a periodic basis, which is quite a headache. Public accounting firms prepares, maintains and review their clients' financial statements and records. They also assist in calculating taxes and submitting tax returns. Various examples of public accounting firms are PricewaterhouseCoopers, Ernst & Young, KPMG. They might also provide auditing services to their clients. US Securities and Exchange Commission was established in June 6, 1934. It's headquartered in Washington, D.C. It was established after the Great Depression, that is the Great Crash of 1929, which shook the US stock markets and resulted in a meltdown. It enforces federal securities law, and these and public listed companies have to abide by the regulations of the federal securities law, and it regulates the security industries as a whole. The Enron scandal led to the legalization of Sarbanes-Oxley Act in 2002. So we will now understand what went wrong in Enron. The Enron scandal, which was revealed in October 2001, led to the bankruptcy of Enron Corporation, a major energy firm, American energy firm based in Houston, Texas, and it also led to the dissolution of Arthur Andersen, which was one of the 5 largest audit companies of the world in those days, which used to audit Enron. Enron was founded in Omaha in Nebraska. It was founded by the chairman Kenneth Lay by merging Houston Natural Gas and Internorth. Kenneth Lay increased the revenues of Enron approximately by 311% from 1990 to 1998 by selling electricity at very high prices, and it also diversified Enron by moving into other fields like water plants, pulp and paper plants, and other natural gas plants. Several years later, when Jeffrey Skilling was hired by Enron, he developed a team of executives who devised various accounting loopholes. He used special purpose entities and various other unethical approaches towards accounting to hide various credit debts, which Enron faced during those days, and it shows a mirage effect to the investors about the good health of the company. Now Enron prices rose to as high as $90 per share in mid 2000, but it plummeted to around $1 per share at the end of 2000. Investors lost around $11 billion, and on December 2, 2001, Enron filed for bankruptcy. So what really went wrong in Enron? First is the auditor's conflict of interest. Prior to SOX, auditing firms were self-regulated, and they were also indulged in some lucrative consulting agreements with the same clients which they used to audit. For example, Arthur Andersen used to audit Enron for almost a decade, but they were also involved in providing certain consultative agreements to Enron, which raises a suspicion of conflict. Boardroom failures, specifically the board of directors and the audit committee, they were unable to gauge the volatility of risk in the market because they were either not expertise enough to understand the complex business processes, or they went blind to various malpractices which were occurring in Enron. Also, the audit committees of Enron were not really independent of the top management. Enron scandal costed investors $11 billion loss when the share prices of Enron plummeted down from mid-2000 level of more than $90 per share to a level of less than $1 in mid-2001. US Securities and Exchange Commission investigated Enron scandal, and Dynegy came forward, which is a competitor for Enron in Houston, They approached Enron to buy it, but the deal failed, and finally on December 2001, Enron filed for Chapter 11 of the United States Bankruptcy Code and filed for bankruptcy. The case study of Enron raised up various issues like auditor conflicts of interest, boardroom failure, security analyst conflict of interest, inadequate funding of SEC, banking practices, internet bubble, executive compensation. Now we will look at much into detail now. Auditors conflict of interest. In the case of Enron, we found that Arthur Andersen, who used to audit Enron, also used to engage in various lucrative consulting agreements with them, and these consulting agreements were far more lucrative than the audit which they were doing for Enron, and they were self-regulated, and which led to an auditor conflicts of interest. And it was also said that Arthur and Andersen were pressurized to not to disclose the findings after they did an audit for Enron in 2000. And most of the audit work papers of Enron were shredded and were burned by Arthur Andersen when a team of investigating officials reached the Arthur Andersen official headquarters. Boardroom failures specifically relates to the board of directors and the audit committees who failed in providing adequate measures to keep a check on the financial audit reports of Enron. They either did not knew their job, or they kept blind to the various malpractices which were going on in Enron. Securities analyst conflicts of interest. Security analysts gave a recommendation on the buy and sell of a company's stock and bond, and they were also engaged as an investment bankers where they provide loans to Enron and were also consulting them in various mergers and acquisitions. So the job of securities analyst also raises an issue of suspicion. Inadequate funding of SEC. In pre-SOX era, the Securities Exchange Commission was not properly funded, and there were very less employees and auditors to keep a check on the various working of the public listed companies, and therefore a scandal like Enron was inevitable. Banking practices. Lending to an investor gives a signal to lending to a firm gives a signal to the investors regarding a firm's risk. In the case of Enron, major banks provided huge loans to Enron without taking into consideration the risk posed by the company, because they were giving loans to Enron based on the goodwill of Enron. So therefore, the investors who invested money in banks as well as various clients were hurt by such bad loans, and banks had to settle all these payments by shelling out most of its assets. Internet bubble. Technology stocks in 2000 were at very high level. Various mutual fund managers gave buy and sell recommendation of certain technology stocks. When the prices of those stocks were going down, they gave recommendation that people should buy those stocks, when on the other hand they were quietly selling them. So the mutual fund managers' role also created an anger in the hearts of investors. And executive compensation was very largely done in pre-SOX era, whereby the board of directors, the various committee members always had to chase the Wall Street targets, and in doing such things they were involved in various malpractices, and they used to cook the balance sheets, and because so that they can get compensated appropriately and in a very high fashion. So to counter-attack the Enron scandal and to see that such scandals does not happen in the future, Sarbanes-Oxley Act was implemented. So it has 11 titles. The various titles of Sarbanes-Oxley Act are as follows: Public Company Accounting Oversight Board, Auditor Independence, Corporate Responsibility, Enhanced Financial Disclosures, Analyst Conflicts of Interest, Commission Resources and Authority, Studies and Reports, Corporate and Criminal Fraud Accountability, White Collar Crime Penalty Enhancement, Corporate Tax Returns, and Corporate Fraud Accountability. Let us now see all these in detail. Public Company Accounting Oversight Board, Title 1. It consists of 9 sections, and it provides the public company accounting oversight boards to register existing accounting firms, to review the registered firms, and to impose penalties on all those auditors who weren't doing the job properly. It can comprise of 5 members, out of which maximum 3 could be from a single political party, and there should be a maximum of 2 certified public accountants in the Public Company Oversight Board. Title 2 is the auditor independence. As we saw in Enron that Arthur Andersen was the auditors of Arthur Andersen were mainly engaged in consulting arrangements with Enron as well, and therefore it created a conflict of interest. Therefore, the Title 2 auditor independence establishes standards for external auditor independence. In addition to these limitations, audit functions and all other non-audit functions provided to the audit clients must be pre-approved by the board, and also it had requirements for new auditor approval. It also has the requirements for reporting done by the auditor and audit partner rotation, wherein the lead partner should be rotated on 5 years and other partners should be rotated on an interval of 7 years. Title 3 is the corporate responsibility. It consists of 8 sections and it organizes an audit committee. It specifies that the individual senior executives of the organization must take individual responsibility about the appropriateness and accuracy of the financial reporting of the organization. Also, the CEOs and the CFOs, that is the principal officers of the organizations, must certify in any periodic report the truthfulness and accurateness of that report. And if they are unable to do so, then their bonuses might be forfeited, and there are other criminal penalties which might act against them if they fail to certify their financial accounts. Title 4 is called Enhanced Financial Disclosures. In pre-SOX era, what used to be done that most of the deals which failed in case of Enron, they were thrown into off-balance sheet transactions or pro forma figures, and they were not shown in the main financial reporting of the periodic financial reporting of the organizations. Now, with the implementation of Sarbanes-Oxley Act, the issuers must disclose off-balance sheet transactions as well in periodic reports, and no issuer shall make, extend, modify, review any personal loans to CEOs and CFOs. Also, the corporate managers' stock transactions also need to be published in the financial disclosures, and any changes made to the financial statement of the organization, any material misstatement which came into light and how it was rectified, it all should be reported in the Enhanced Financial Disclosure clause of Sarbanes-Oxley Act. Analyst conflicts of interest. Security analysts who make a buy or sell recommendation for a company's stocks or bonds were also involved as an investment banker in various public firms as well. So it created a conflict of interest. Therefore, to mitigate the repercussions of such acts, analyst conflicts of interest was laid out. It improved objectivity of research and provide investors with useful and reliable information. They see to it that the security analysts provide accurate and truthful information about a company's stocks and bonds, and it defines code of conduct for security analysts. And if they are involved in some other means with a public firm, then they have to disclose all their conflicts of interest. Either it's a criminal offence as well. Title 6 is called the Commission's Resources and Authority. As we saw earlier that a Securities Exchange Commission had very few resources and very few employees to keep a vigil on the working of public listed companies. So Commission Resources and Authority, what they did that they increased the money given to Securities Exchange Commission to $780 million, and additional 200 employees were engaged to provide an enhanced oversight of the various workings of the public companies and public accounting firms. It established minimum standards for professional conduct for attorneys practicing before it, and if a security professional is found to be engaged in any fraudulent activity during the investigation process, then there could be any criminal penalties could be imposed against them, and he may be barred from practicing as a broker, dealer or an advisor. Title 7 is called the Studies and Reports, and it gives Comptroller General and the Securities Exchange Commission the authority to do various studies and report their findings. And these findings helps in restoring investor confidence in the reporting of securities analysts. The findings could be related to the consolidation of public accounting firms, any security violations that took place, and what enforcement actions were taking place in a particular firm when such a security violation took place. All these findings have to be reported in the under the studies and reports of Sarbanes-Oxley Act. Title 8 is called Corporate and Criminal Fraud Accountability. It consists of 7 sections, and it states that to knowingly destroy, create, manipulate documents and or impede or obstruct federal investigation is considered felony, and violators will be subject to fines or up to 20 years imprisonment or both. So people who involve in fraudulent activities or who try to manipulate with the financial documents of an organization to hide debts or some other things, then they will be subjected to imprisonment or fine or both. And as we learned earlier, that Arthur Anderson, when they were asked about the audit reports, they said that they burned all these audit reports because earlier they didn't had a clause to of an audit report retention policy. Then because of that case, Corporate and Criminal Fraud Accountability stated that all the audit work papers should be retained for at least 5 years, and it also states the whistleblower protection. So this act is also called as Whistleblower Protection Act. It states that people who exposes any wrongdoings or wrongdoings or malpractices in an organization, if the companies take any strict actions against them, or they are subjected to adverse conditions, then criminal penalties could be staged against firms. Title 9 is called a white collar crime penalty enhancement. It consists of 6 sections. It states that the financial statements must be certified by the CEOs, and violations will result in fines or up to maximum of 20 years of imprisonment. And anyone convicted of securities fraud may be banned by the Security Exchange Commission from holding officer or director positions in public companies. Corporate tax return consists of 1 section only, and it states that the corporate income tax returns must be signed by the chief executive officer of the organization. Title 11 is called the Corporate Fraud Accountability, and it consists of 7 sections. It also says that the destroying or altering a document or record with the intent to impair the object's integrity for the intended use in a securities violation proceeding or otherwise obstructing that proceeding will be subject to a fine and or up to 20 years of imprisonment. For example, if something goes wrong in an organization, and if Securities Exchange Commission has come there and it is investigating the fraudulent activity, and if during that investigation somebody tried to manipulate with the investigation, somebody tried to influence the investigation, then he might be subjected to a fine or up to 20 years of imprisonment. And those who are involved in an investigation process, if they are found to engage in fraudulent activities, then the payment could be freezed by SEC. It has the authority to do it. And also any retaliatory act against whistleblowers or people who exposes the malpractices in an organization, any such thing is subject to fine and or 10-year imprisonment. There, we must also talk about various key provisions of Sarbanes-Oxley Act. Sarbanes-Oxley Act came up with 2 kinds of provisions. First is the civil provision, other is the criminal provision. Civil provisions is comprises of section 302, and the section 906 talks about the criminal provision. Sarbanes-Oxley section 302, disclosure controls. It mandates that a set of internal procedures be designed to see that the financial reporting which is done periodically in an organization is accurate and appropriate. It must also be seen that these internal controls are audited by an external auditor, and he gives his opinion on the fairness and accuracy of the internal controls, as well as whether these internal controls are effective in doing the work. Sarbanes-Oxley Section 404 is the most contentious section of Sarbanes-Oxley Act. It consists of the assessment of internal control, whereby the management as well as the external auditors have to assess the internal control environment of an organization, and because it consists of various documentation and testing processes, that's why this Section 404 is considered as the most costly aspect of Sarbanes-Oxley Act, and the main worth of the cost is seen by smaller public companies who find them unable to comply with such stringent regulations of Sarbanes-Oxley Act. Sarbanes-Oxley Section 401 talks about the disclosures in periodic reports, that is off-balance sheet items. As discussed earlier, anything if a company is indulged in any contract with some other organization, or it indulges in any other activity with some other firms, then they don't have to hide them. They have to show the debt. They have to show the losses in their balance sheet. So it talks about showing the off-balance sheet items in the main financial reports of the organization. Section 802 talks about the criminal penalties which might be imposed against people who aims to alter, destroy, or mutilate or influence the investigation or financial disclosures of an organization. And it also says that a person, if found doing so, he might be imprisoned for not more than 20 years, or he might be imposed or slapped a financial penalty. As we saw earlier as well, criminal penalties for retaliation against whistleblowers. Whistleblowers, if somebody tries to harm the whistleblower or influence the whistleblower in some or the other way, then he shall be imprisoned not more than 10 years or should be fined under the statute of both. Now, analyzing the cost and benefits of Sarbanes-Oxley, various studies and reports suggest the various compliance costs as well as benefits to firms and investors who comply to Sarbanes-Oxley Act. It has been summarized here in front of you, the essence of various reports. So, FEI survey, Financial Executive International, did a survey on Sarbanes-Oxley Act, and they did a survey on 168 companies whose average revenues were $4.7 billion. The cost of compliance for Sarbanes-Oxley Act was found to be around $1.7 million, which was 0.036% of revenue. When the same survey was done on smaller public companies, it was found that the cost of compliance was around 2.5% of the revenue. Also, the cost of compliance for decentralized companies or companies with various other subsidiaries or various other parallels are the cost of compliance for decentralized companies are more. Foley and Lardner survey was conducted in 2007, and it suggested that nearly 70% of survey respondents indicated public companies with revenues under $251 million should be exempt from SOX Section 404 because it imposes a large overhead of compliance cost on smaller public companies or companies with revenues under $251 million, because they have to go through various paperwork, they have to assess their controls, they have to hire certified public accountants to make an assessment of the financial disclosures of the organization. It comes with a large overhead. JAN did a survey in 2005, and it estimated that the SOX compliance cost as high as $1.4 trillion for an organization, and the JAN survey is considered as the most startling survey for SOX Compliance Act. And a 2011 Securities and Exchange study found that the Section 404B compliance costs have continued to decline, especially after 2007 accounting guidance, whereby the PCOB came up with guidance auditing standards number 5. Earlier in 2004 they came up with auditing standard number 2, but they refined it more for keeping in mind the not so good conditions of smaller public companies who were finding them unable to stringently comply with the Section 404 of the disclosure of internal controls. What are the various benefits to firms and investors? Various findings were done on this as well, and various research activities took place. One of the research activity was done by Arping and Shortney in 2010. It says that cross-listed firms, foreign firms which are also listed in US became significantly more transparent following SOX, taking into consideration the serious criminal and civil penalties that are imposed if you go against SOX requirements. And research was done by Elite in 2007. It indicated that SOX 404 indeed led to conservative reported earnings, and which says that the share prices of companies who were going by SOX 404 was coming down a little bit. Institute of Internal Auditors in 2005 conducted a survey, and it found out that companies who comply to the Sarbanes-Oxley Act Sarbanes-Oxley Act have improved the internal controls, and their financial statements are found to be more accurate, appropriate and reliable. Lord Benoit report was conducted in 2006, and it says that companies who were indulged in stringently complying with the section 404 of the Sarbanes-Oxley Act had found that the share prices have increased considerably. What are the effects on exchange listing choice of non-US companies? It was found out that after the implementation of Sarbanes-Oxley Act, most of the public listed companies were going off the stock exchange markets. They were going private, or they were either going out of USA and most preferably to London, where the rules are not as stringent as in the United States. And it suggested that Sarbanes-Oxley legislation has helped displace business from New York to London. Therefore, since the proponents of the bill claimed, opponents of the bill said that it has reduced US financial competitive edge over foreign financial service providers. It came out that it is true as per Piotr and Srinivasan research paper of 2008. There are various pros, there are various advantages of Sarbanes-Oxley Act. It restored confidence in securities markets, which got displaced after Enron, Peregrine and WorldCom scandals. It had a significant positive impact on corporate governance, because now the corporate managers are using a risk-based audit approach to see that the financial disclosures are appropriate and accurate, and that the internal controls revolving around the financial controls are effective in doing the job. And the financial statements came out to be more reliable after SOX was implemented, and also a sense of resilience and ethical culture took birth in the organization when it started complying with the SOX laws. There are various disadvantages as well, as I mentioned earlier, that companies who were afraid of criminal and civil penalties, they started listing down themselves from the public listed firms of USA, and they were moving out of USA as well. And the increase in compliance costs for small public companies, because there is a large overhead on small public companies to hire certified public accountants, and bureaucracy paperwork is also need to be done by small public companies to enhance their financial disclosures to comply with the Sarbanes-Oxley Act. So, as a conclusion, I would just like to conclude that SOX is a legislative attempt to create momentum and regulation, and it improved the public confidence in the US securities markets, and also it helped the corporate management to take a closer look in the financial disclosures of the organization, and to see to it that the internal controls that are revolving around the financial reporting of the organization are effective and appropriate. Thank you.